You picture retirement as a single number, a pile of savings you draw down year after year, hoping it lasts. But that's not how the wealthiest retirees actually think about it. They don't think about a pile. They think about pipes, 5 separate pipes, each one flowing income into their life month after month, regardless of what the stock market is doing that week. And when you understand how those 5 pipes actually work and how to stack them together, retirement stops feeling like a countdown and starts feeling like a paycheck that never stops. Let's build this one pipe at a time. Pipe number 1, the one you already have, whether you realize it or not. Social Security. Most people think of Social Security as a supplement, a nice-to-have that covers groceries. But structurally, it's something far more valuable. It's the only income stream in your entire retirement that's guaranteed for life, adjusted for inflation every year, and completely immune to market crashes. No stock portfolio can promise that. No rental property can promise that. Social Security can, because it's backed by the federal government's taxing authority, not by market performance. Here's what makes this pipe especially powerful. Every year you delay claiming past your full retirement age up until 70, your monthly benefit grows by roughly 8%, guaranteed. That's not a projection. That's not hopeful thinking. That's a contractual increase, and it compounds into a dramatically larger lifetime income stream if your health and circumstances allow you to wait. Think of Social Security as your foundation pipe. It's the one flowing no matter what. Every other pipe you build gets stacked on top of this one, and the stronger this foundation is, the less pressure sits on everything else. Pipe number 2, dividend income. When you own shares of companies that pay dividends, you're not just hoping the stock price goes up someday. You're getting paid in cash on a regular schedule, simply for owning a piece of that business. Many well-established companies have paid and even increased their dividends every single year for decades, through recessions, through market crashes, through every kind of economic turbulence imaginable. Jeremy Siegel, a finance professor who has spent much of his career studying long-term market returns, has shown through historical analysis that dividends have historically made up a substantial portion of the stock market's total long-term return, not just the price appreciation everyone talks about. Reinvest those dividends during your working years, and they compound into more shares, which pay more dividends, which buy more shares. Then, in retirement, you flip a switch. Instead of reinvesting, you simply collect the cash. Here's why this pipe feels different from simply selling shares for income. When you sell shares to generate cash, you're shrinking your pipe every single time. When you collect dividends, the pipe itself can keep growing because you still own every share, and many of those companies keep raising their dividend payments year after year, which means your income stream can actually increase over time, often faster than inflation. Pipe number 3, real estate income. This one takes a few different shapes, and it's worth understanding all of them, because they carry meaningfully different levels of effort and risk. The most direct version is owning a rental property and collecting rent checks. This can be a powerful pipe, but it comes with real responsibilities, tenants, maintenance, vacancies, property management. It's income, but it's not entirely passive. The more passive version involves real estate investment trusts, commonly called REITs, which let you own a slice of large portfolios of commercial or residential real estate without ever fixing a leaky faucet yourself. REITs are legally required to distribute the vast majority of their taxable income to shareholders, which is exactly why they tend to pay meaningfully higher income yields than typical stocks. Data compiled by REIT, the trade association representing the REIT industry, has shown that publicly traded REITs have historically provided a combination of income and growth that behaves somewhat differently from the broader stock market, since real estate values and rental income don't always move in lockstep with corporate earnings. That difference matters enormously when you're trying to build multiple pipes that don't all get hit by the same storm at the same time. Whether you choose direct property ownership, REITs, or a mix of both, real estate income tends to have one particularly attractive feature. Rent, broadly speaking, tends to rise with inflation over time, which means this pipe can help protect your purchasing power precisely during the years when the cost of everything else is climbing. Pipe number 4, guaranteed income through annuities. This is the pipe that makes people the most nervous. usually because the word annuity carries a reputation, often deserved, for high fees and confusing structures sold aggressively by commission salespeople. But strip away the bad examples, and the underlying concept is simple and, for the right situation, genuinely powerful. An annuity, in its most basic form, is a contract with an insurance company. You give them a sum of money, and in exchange, they promise to pay you a fixed income for the rest of your life, no matter how long you live. It's essentially the mirror image of life insurance. Life insurance protects against dying too soon. An annuity protects against living too long and running out of money. Wade Pfau, a retirement researcher who has extensively studied how guaranteed income products fit into a broader retirement plan, has argued that annuities, specifically simple, low-cost versions, can meaningfully reduce the risk of running out of money precisely because they transfer longevity risk away from you and onto an insurance company that pools that risk across millions of policyholders. The key word here is simple. A basic, low-cost immediate annuity or deferred income annuity can function as a personal pension, converting a portion of your savings into a guaranteed paycheck for life. The complex, high-fee variable annuities loaded with riders and surrender charges are a different animal entirely, and they're often exactly what gives the whole category its bad reputation. Understanding the distinction matters enormously if you ever consider this pipe. Pipe number 5. Bonds and fixed income laddering. Bonds don't get nearly as much attention as stocks in most retirement conversations, but they play a specific, crucial role. When you buy a bond, you're essentially lending money to a government or a corporation in exchange for regular interest payments and the return of your original amount at a set future date. The real power here comes from a strategy called bond laddering, where instead of buying one bond with one maturity date, you buy a series of bonds that mature at staggered intervals, one next year, one the year after, one the year after that, and so on. As each bond matures, you receive that principal back, which you can either spend or reinvest into a new, longer-dated bond, keeping the ladder going. This structure does something valuable that a single lump investment can't. It creates predictable, staggered cash flow that isn't dependent on selling anything at a potentially bad moment in the market. If stocks crash the same year one of your bonds matures, that maturing bond still pays out exactly as promised, completely unaffected by what's happening in the stock market that day. Now here's where this stops being 5 separate ideas and becomes one coordinated system. The real power isn't any single pipe. It's how they stack together. Think about what each pipe is naturally good at, and notice how they cover each other's weaknesses. Social Security is your unshakable floor, guaranteed and inflation adjusted, but it alone usually isn't enough to fully fund a comfortable retirement. Dividend income can grow over time and historically has held up reasonably well through many market cycles, but individual company dividends can still be cut during severe downturns. Real estate income tends to track inflation well, but it can be less liquid and, in the case of direct property ownership, requires ongoing management. Annuity income is rock solid and guaranteed for life, but it's typically fixed, meaning it doesn't grow much unless you specifically choose an inflation-adjusted version, which usually costs more upfront. Bond laddering provides precise, predictable timing, but the income itself is generally more modest than what stocks or real estate can potentially provide over long periods. None of these 5 pipes is perfect on its own, but stack them together and their individual weaknesses start covering for each other. When the stock market has a rough year and dividend growth slows, your bond ladder and annuity payments keep flowing exactly on schedule, completely indifferent to what happened on Wall Street that day. When inflation spikes and fixed annuity payments start losing purchasing power, your real estate income and any Social Security cost of living adjustments help offset that erosion. This is fundamentally different from the traditional approach most people default to, which is essentially one giant pipe, a single investment portfolio that you slowly sell down over 30 years, hoping the math works out. That approach concentrates every single risk, market risk, sequence risk, longevity risk, into one pipe. If that one pipe gets damaged at the wrong moment, There's nothing else to lean on while it recovers. Diversifying your income streams isn't just about diversifying your investments in the traditional sense of owning different stocks. It's about diversifying the actual mechanisms that generate your cash flow so that a single bad year, a single bad decade even, doesn't threaten your entire standard of living. So how do you actually start building this? Whether retirement is decades away or right around the corner. If retirement is still years off, this is largely about intentional construction. Every dollar you invest can be thought of as choosing which pipe to strengthen. Contributing to dividend-paying index funds strengthens pipe 2. Adding a REIT allocation strengthens pipe 3. Building a bond ladder that matures right around your target retirement date strengthens pipe 5. You're not randomly accumulating assets anymore. You're deliberately engineering multiple income sources that will eventually work together. If retirement is approaching, this is the moment to start thinking about sequencing. Which pipes do you want flowing immediately, and which ones can wait? Delaying Social Security a few extra years to maximize that guaranteed foundation might make sense if your other pipes can cover the gap in the meantime. Converting a portion of savings into an annuity might make more sense closer to, or even into, retirement, once you have clearer visibility into your actual expenses and remaining life expectancy. If you're already retired, this is about auditing what you currently have. How many of these 5 pipes are actually flowing right now? If you're relying almost entirely on one pipe, most commonly a single investment portfolio being slowly sold down, understanding these 5 categories might reveal opportunities to convert a portion of that concentrated risk into more diversified, resilient income streams. Here's the deeper truth underneath all of this. Retirement income isn't really about the size of your savings account. It's about the number and the diversity of pipes flowing into your life. $1 million sitting in a single stock portfolio is genuinely riskier in terms of income reliability than a smaller amount spread thoughtfully across Social Security, dividends, real estate, guaranteed annuity income, and a bond ladder, even if the total dollar figure looks smaller on paper. This reframing changes the entire emotional experience of retirement. Instead of anxiously watching a single account balance fluctuate with every market headline, you're watching 5 separate, largely independent income streams, each one doing its specific job, each one covering for the other's weaknesses. You've spent decades building a single pile of savings, watching one number, hoping it's big enough. Now you understand something different. Retirement isn't about the size of the pile, it's about how many pipes you've built and how well they work together, flowing income into your life for as long as you live. Let's go back and add depth to a few of these pipes, because the surface explanation only tells part of the story, and the details are where the real strategy lives. Start with Social Security again, because the way most people think about the delay decision misses something important. It's easy to frame delaying as simply getting a bigger check later, but that framing undersells what's actually happening. Every year you wait is essentially buying more guaranteed, inflation-protected income at a price that becomes increasingly attractive the longer you're likely to live. For a healthy person with family longevity on their side, delaying from 62 to 70 can mean a monthly benefit that's dramatically larger, locked in for the rest of their life, immune to market crashes, immune to interest rate changes, immune to nearly everything except the solvency of the program itself. This is why financial researchers so often describe Social Security as functioning like the world's best inflation-adjusted annuity, one you can't actually buy on the open market at any price because private insurance companies simply can't offer contracts this favorable. Understanding that reframes the delay decision entirely. You're not just waiting for a bigger number, you're purchasing the single most valuable guaranteed income asset available to you, using years you've already worked for rather than a lump sum of cash. Now revisit dividend income with more precision, because there's a meaningful difference between chasing high current yield and building genuine, growing income. Some companies pay unusually high dividend yields specifically because their stock price has fallen sharply, often signaling underlying business trouble rather than genuine value. Chasing the highest yield available can actually lead you toward companies most likely to eventually cut their dividend, the opposite of the reliable pipe you're trying to build. A more resilient approach focuses on companies with long, consistent histories of not just paying dividends, but growing them year after year through multiple economic cycles. Some of these companies have increased their dividend payments for 25, 40, even 50 consecutive years, a track record that survives recessions, wars, and financial crises. That consistency matters more than the current yield percentage, because a modest yield that grows reliably every year will eventually outpace a high yield that stagnates or gets cut during the next downturn. This is also where reinvestment timing becomes genuinely strategic. During your working years, automatically reinvesting every dividend payment back into more shares means you're compounding not just your original investment, but the growing stream of cash those shares generate. By the time you actually need the income, you're not just collecting dividends on your original contribution. You're collecting dividends on years of accumulated, reinvested shares, which can meaningfully change the size of this pipe by the time you actually turn it on. Let's add more nuance to real estate income as well, because the choice between direct property ownership and REITs isn't just about effort level. It's about a genuine trade-off in risk and control. Direct property ownership gives you leverage, the ability to use borrowed money to control an asset larger than your actual cash investment, which can amplify returns significantly. It also gives you direct control over decisions like rent increases, renovations, and tenant selection. But it concentrates risk into a single asset, in a single location, and it demands active management or the cost of hiring someone else to handle that management for you. REITs spread that same real estate exposure across dozens or even hundreds of properties, often across different property types: apartments, office buildings, shopping centers, warehouses, data centers, which reduces the impact of any single property or tenant underperforming. You trade some potential upside and control for genuine diversification and complete passivity. For many retirees, specifically prioritizing reliable income without ongoing management responsibilities, that trade-off tilts clearly in favor of REITs, or a thoughtful combination of both approaches. Now let's go deeper on annuities, because the fee structure genuinely matters more here than in almost any other financial product category. A simple, immediate annuity, where you hand over a lump sum and immediately begin receiving guaranteed monthly payments for life, typically carries minimal ongoing fees, because the insurance company's profit comes from pooling longevity risk across many policyholders, not from layered annual charges. A deferred income annuity works similarly, but delays the start of payments to a future date you choose, often allowing for a larger eventual payout in exchange for that waiting period. Compare that to variable annuities loaded with riders, guaranteed minimum income benefits, guaranteed minimum withdrawal benefits, death benefit riders, each one sounding appealing individually, but each one adding another layer of annual fees that can quietly erode returns over decades. Wade Pfau's research has specifically distinguished between these simple, low-cost, guaranteed income products and their more complex, expensive cousins, noting that the value proposition of annuities as longevity insurance holds up far better in the simple versions than in products weighed down by excessive fees and complexity. The practical takeaway is straightforward, even if the annuity landscape itself is confusing. If this pipe makes sense for your situation, simpler is almost always better. A contract you can explain in one sentence is usually a stronger foundation than one that requires a lengthy prospectus to understand what you're actually buying. Finally, let's add precision to the bond laddering pipe, because the strategy becomes significantly more powerful when it's built with intention around your specific retirement timeline. Imagine structuring a ladder so that a bond matures every single year for the first 10 years of your retirement, each one sized to cover a meaningful portion of that year's expenses. This creates a rolling, predictable cash flow that's completely disconnected from daily market movements. If stocks are down 30% the exact year you need income, it simply doesn't matter for the portion of your expenses covered by that year's maturing bond. You're not forced to sell depressed stock investments at the worst possible moment, which, as any retirement researcher studying sequence of returns risk will tell you, is precisely the scenario that does the most lasting damage to a retirement portfolio. Once you understand bond laddering this way, it stops being a boring, low-return afterthought and starts looking like precision insurance against exactly the kind of bad timing that derails otherwise well-funded retirements. So let's return to the coordinated system these 5 pipes create together, because this is where the real strategic value lives. Picture a retirement year where the stock market drops significantly. Your dividend income might dip slightly if a few companies temporarily reduce payouts, though historically, broad dividend income has proven far more stable than stock prices themselves during downturns. Your real estate income, particularly if it comes from diversified REITs, likely continues largely unaffected since rental demand doesn't disappear just because stock prices fell. Your annuity payment arrives exactly on schedule, completely indifferent to what the market did that quarter. Your bond ladder's scheduled maturity pays out exactly as promised, and your Social Security check, adjusted for inflation, keeps arriving without interruption. In that scenario, only one of your 5 pipes experienced any real disruption, and even that disruption was modest compared to what a single, concentrated stock portfolio would have experienced. You didn't have to sell anything at a loss. You didn't have to panic. You simply let the other 4 pipes carry more of the weight that year, while your damaged pipe had time to recover. This is the entire point of stacking multiple income streams. It's not about maximizing the return on any single pipe. It's about ensuring that no single bad year, in any single asset class, can meaningfully threaten your standard of living, because the other pipes are structurally unlikely to all get hit by the exact same problem at the exact same time. You've spent decades building a single pile of savings, watching one number, hoping it's big enough. Now you understand something different. Retirement isn't about the size of the pile. It's about how many pipes you've built and how well they work together. Flowing in, you've spent decades building a single pile of savings, watching one number, hoping it's big enough. Now you understand something different. It's not about the size of the pile. It's about how many pipes you've built and how well they work together. And if you haven't already, go watch our video before you retire. Watch this video or risk running out of money at 78. It covers the exact risk that makes stacking these 5 income streams so important in the first place. Every week, this channel breaks down another way to build a retirement that actually holds up, not just on paper, but through real market cycles, real downturns, and real life. So if you want more of this, hit subscribe and turn on notifications so you never miss the next pipe. See you in the next one.